Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Last video I have completed 3 problems on ratio analysis. Now in this video, problem number 4, I am going to explain you in detail. So all the problems on ratio analysis are based on the theory, on the formulas, which I have already given so many videos explaining about ratios, ratio analysis, classification of ratios into liquidity, solvency, activity or turnover and profitability. So if you are perfect on the formulas, then only you can go ahead. Without remembering the formula, without watching the videos of classification of ratios, don't jump, don't come to this video. You cannot be able to understand. So if you have not watched the video on classification of ratios and the formula, I suggest you go to the playlist of my channel, select the subject accounting for management, select the videos of ratio analysis, different ratios like liquidity ratio, one video is there, profitability ratio, one video, solvency ratio, activity ratio. For each category of formulas, category of ratios, one separate video is there. Select the video, be clear, be perfect about the formula, then only you come to the problems. So before starting the problem number 4, take the screenshot of the points which I have written on the board, then I'll explain the complete problem in detail. Now, so before starting the problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. So always keep this printout ready before watching the video. Now, fourth problem. From the following information, you are required to prepare balance sheet. Again, a reverse back problem. The ratios are given in the problem. By using the ratios, we have to calculate different assets and different liabilities. And after finding out the assets and liabilities, make a balance sheet, right? So here different ratios are given. Current ratio 1.75, liquid ratio 1.25, stock turnover ratio. Formula is given, cost of sales by closing stock 9, gross profit ratio 25%, debt collection period 1.5 months, reserves and surplus to capital 0.2. Turnover to fixed assets. In bracket it is given cost of sales by fixed assets. Actually the original formula for turnover to fixed asset is sales by total asset, sales by fixed assets. But sometimes in the problem itself it will specify the formula. Here also turnover to fixed assets. The formula which is to be used is cost of sales by fixed assets. So in the problem itself you write down. It will be given in the problem, examination. So turnover to fixed assets, in bracket you write on cost of sales by fixed assets. So cost of turnover to fixed assets 1.2. Capital gearing ratio 0.6. Fixed assets to net worth 1.25. And lastly, sales for the year 12 lakh. Now we have to select which items we can start our calculations. Sales are given 12 lakh. And gross profit ratio is given 25%. By using this gross profit ratio and sales, we can find out the gross profit. Once when we have the sales and gross profit, we can calculate cost of sales. So we can find out the gross profit, we can find out the cost of sales by using GP ratio, gross profit ratio and sales, which are given in the problem. So first of all, gross profit ratio is given 25%. That means gross profit is 25% of sales. GP ratio always is calculated as a percentage of sales. So 25% of sales. Sales are given in the problem 12 lakh. So 25% of 12 lakh, you will get gross profit 3 lakh. So one item we got gross profit. And we already know cost of goods sold, COGS. The formula is sales minus gross profit. Sales minus gross profit, you will get cost of sales, cost of goods sold. The cost of goods sold is equal to sales 12 lakh, gross profit 3 lakh. So 9 lakh rupees is the cost of goods sold. That's all. So by using this, we have calculated gross profit and cost of sales. Now we make use stock turnover ratio. Stock turnover ratio is given 9. Actually, the formula for stock turnover ratio is cost of goods sold by average stock. But if we can't be able to calculate average stock, we can take the closing stock. In the problem itself, it has specified the stock turnover ratio is cost of sales by closing stock. It is given in the problem. So, cost of goods sold by closing stock is 9. Now, cost of goods sold, just now we have calculated 9 lakh. So, in place of cost of goods sold 9 lakh divided by stock is equal to 9. Now, I am making a cross multiplication here by 1. So, make a cross multiplication. 9 into stock is equal to 9 lakh into 1. This numerator with this denominator, this numerator with this denominator. So 9 into stock, 9 stock, 9 lakh into 1, 9 lakh. So 9 stock is equal to 9 lakh, stock is equal to 9 lakh divided by 9. Here there is multiplication, 9 into stock. So if I take that 9 to right hand side, it will become divide. So 9 lakh divided by 9, you will get 1 lakh. So we got the value of closing stock. See how we are calculating all the values one by one. So we got the closing stock. Now current ratio. The current ratio and liquid ratio both are given. Current ratio is given 1.75 and liquid ratio is given 1.25. 1.75, 1.25. So we subtract current ratio minus liquid ratio. See, current ratio minus liquid ratio is equal to 1.75 minus 1.25. So what is the formula for current ratio? CA by CL, current asset by current liability. What is the formula for liquid ratio? Quick asset by current liability. Liquid ratio or quick ratio means one and the same. So quick asset by current liability is equal to 1.75 minus 1.25. You will get 0.5. Now take the LCM, CL, CL. Denominator here CL, here CL. So LCM is CL. So numerator CA minus QA. So CA minus QA divided by CL is equal to 0.5. Now we know CA minus QA is nothing but stock. In the previous video, in formulas, I have already explained that quick asset is equal to current asset minus quick asset. Current asset minus stock. Quick asset is equal to current asset minus stock. Or if I take the stock to LHS, minus stock will become plus stock is equal to CA. This plus QA, if I take it to the RHS, it will become minus QA. So in other words, we can say stock is nothing but current asset minus quick asset. So here already we have current asset minus quick asset. So in place of this, I will write down stock. So stock by CL is equal to 0.5. Now stock, already we have calculated the stock 1 lakh. So in place of stock, I am writing 1 lakh. 1 lakh divided by CL is equal to 0.5. Now if I make a cross multiplication like this, then what will happen? 0.5 into CL is equal to 1 lakh into 1. 1 lakh into 1 is 1 lakh. So 0.5 CL is equal to 1 lakh. So CL is equal to 1 lakh divided by 0.5. Because LHS there is a multiplication 0.5 into CL. So if I take this 0.5 to RHS, it will become divide. So 1 lakh divided by 0.5, you will get 2 lakh. Use the calculator. Always, while I am explaining this, always keep a notebook, a calculator ready. So that whenever I say something new, which you don't know, immediately you should write it down. And calculator, whatever I am saying, immediately calculate and check whether it is correct or not. So 1 lakh divided by 0.5 is 2 lakh. So we got current liability. See here, first of all we have calculated COGS. First we calculate gross profit. Then we have calculated COGS. Then by using this COGS we have calculated stock. By using the stock we have calculated current liability. Now, current ratio. The current ratio is 1.75 given in the problem. The formula for current ratio is CA by CL. So CA by CL is equal to 1.75. CL already we know, current liability we got 2 lakh. So in place of CL I am writing 2 lakh. So CA by 2 lakh is equal to 1.75. Again I am making a cross multiplication. Now CA into 1 is CA. 2 lakh into 1.75, you will get 3,50,000. That's all. So we got current assets also. See, one by one value I am going to ascertain by using the ratios. Now debt collection period. In the problem, debt collection period is given as 1.5 month. It is given here. Debt collection period 1.5 month. If I want to convert it into times, so year consists of how many months? 12 months. So if you want the debtors turnover ratio, by using the debt collection period, I am calculating debtors turnover ratio. 12 months in the year divided by debt collection period 1.5. So 12 divided by 1.5, you will get 8 times. That means the debtors turnover ratio is 8 times, right? Now the formula for debtors turnover ratio is net credit sales divided by average debtors. But we can't calculate average debtors. Opening debtors are not there. So instead of average debtors, we can take closing debtors. In place of average debtors, we will take the closing debtors. And net credit sales, we don't have the information regarding cash sales, credit sales. So we assume whatever sales are given in the problem, that is credit sale only. So in place of credit sales, I am taking sales. Sales already given in the problem 12 lakh. So 12 lakh divided by debtors is equal to 8. Now I am making a cross multiplication like this. So 8 into debtors is 8 debtors is equal to 12 lakh. Debtors is equal to 12 lakh divided by 8, 1,50,000. See here, one by one I am ascertaining. Here debtors we got. Now current assets. Normally current asset consists of stock, debtors, cash. Here the total current assets are stock, debtors and cash. How much is the current assets we have calculated? 3,50,000. So in place of current asset I am writing 3,50,000. Stock. How much stock we have calculated? 1 lakh. So in place of stock 1 lakh. Debtors 1,50,000. Cash we don't know. So in this equation, one unknown variable is cash. Now 3,50,000 is equal to 1 lakh plus 1,50,000, 2,50,000 plus cash. Now take this 2,50,000 to LHS. So plus 250 will become minus 250. So 3,50,000 minus 2,50,000 is equal to cash. So we got cash is equal to 1 lakh. Now this current asset of 3,50,000 consists of stock rupees 1 lakh, debtors rupees 1,50,000 and cash rupees 1 lakh. That's it. The turnover to fixed assets is 1.2. Here in the problem it is given turnover to fixed assets 1.2. So there is no print there, but it is you have to write it down. The formula for turnover to fixed asset is cost of sales by fixed assets. So cost of sales, cost of goods sold, you can say cost of goods sold or cost of sales. So cost of goods sold divided by fixed asset is equal to 1.2. Cost of goods sold already we have calculated 9 lakh. So in place of cost of goods sold 9 lakh divided by FA fixed asset is equal to 1.2. Again I am making a cross multiplication. So 9 lakh into 1 is 9 lakh. 1.2 into FA, 1.2 FA. So here 1.2 FA is equal to 9 lakh. FA is equal to 9 lakh divided by 1.2. Because there is multiplication sign, it will become division. So 9 lakh divided by 1.2, 7,50,000. We got fixed asset also. Now fixed assets to net worth is equal to 1.25 given in the problem. The formula is fixed assets divided by net worth is equal to 1.25. Now fixed asset already we have calculated 7,50,000. So in place of fixed asset 7,50,000 by net worth is equal to 1.25. Now again I am making a cross multiplication here. So 1.25 into net worth is equal to 7,50,000. So net worth is equal to 7,50,000 by 1.25. You will get net worth is equal to 6 lakh. One point you remember, net worth is nothing but shareholders fund. Net worth means shareholders fund, and shareholders funds consist of share capital and reserves and surplus. Share capital and reserves and surplus combined, that is called shareholders fund, or we can call it as net worth. So here net worth we got 6 lakh. In this 6 lakh there is share capital and also there are reserves. Now next, reserves and surplus to capital is 0.2. Reserves and surplus to capital is 0.2. The formula is reserves and surplus divided by capital is equal to 0.2. Now we don't have reserves and surplus, we don't have capital. So simply we can say like this, if I put it by 1, nothing will happen. Now it means what? When capital is 1, reserves and surplus are 0.2. Capital is 1, reserves and surplus is 0.2. If you add up capital and reserves, you will get net worth. So 1 plus 0.2 is 1.2. So in simple words we can say net worth is 1.2. In 1.2, 1 is the capital and 0.2 is the reserves and surplus. So when capital is equal to 1, reserves and surplus will be 0.2 and net worth will be 1.2. Now we can say when 1.2 is the net worth, it is equal to 6 lakh because net worth already we have calculated. According to ratio, it is 1.2. According to ratio, the net worth is 1.2, but the amount of net worth is 6 lakh. So in other words, we can say 1.2 is equal to 6 lakh. So how much is 1? How much is 0.2? In this 1.2, 1 is the capital and 0.2 is the reserves. So 1 divided by 1.2 into 6 lakh. So 1 divided by 1.2 into 6 lakh is 5 lakh. That means in that 6 lakh rupees, 5 lakh rupees is the capital. Then definitely 1 lakh rupees are the reserves and surplus. So reserves and surplus are 0.2. So 0.2 divided by 1.2 into 6 lakh. So 0.2 divided by 1.2 into 6 lakh, you will get 1 lakh. So we have bifurcated. The 6 lakh rupees net worth consists of 5 lakh rupees capital and 1 lakh rupees reserves and surplus. Capital 5 lakh, reserves and surplus 1 lakh. Next ratio, capital gearing ratio. Actually the formula for capital gearing ratio is long-term debts plus preference share capital divided by equity shareholders fund. This is the formula for capital gearing ratio. But in our problem, we are not given any preference share capital. We are not given any loans. So we simply apply the formula capital gearing ratio is equal to long-term debt divided by share capital. So long-term debt divided by capital is equal to 0.6 given in the problem. Now long-term debt we don't have, but capital already we have calculated 5 lakh. So in place of capital I am writing 5 lakh. Now cross multiply long-term debt into 1. Yahan par divided by 1 if I write, then long-term debt is equal to 5 lakh into 0.6. So 5 lakh into 0.6 will get 3 lakh. So we got long-term debt. So we have used all the ratios which are given in the problem and we have extracted, we have calculated the different values. We got all assets values and all liabilities values. Now by taking those assets and liability, we can easily make the balance sheet. So how the balance sheet will look like, see here, liability side, asset side. First you see the assets, two types of assets are there, fixed assets and current assets. Fixed assets already we have calculated here 7,50,000. So I am taking fixed assets 7,50,000. Now current assets, the total current asset consists of 3,50,000. But we don't take 3,50,000, we want the breakup. In this current assets, we are having stock, debtors and cash. The stock is 1 lakh, debtors are 1,50,000 and cash is 1 lakh. So we write down the three current assets: stock, debtors, cash. Already all these values we have calculated. Now liability side. Liability side, first we take the capital. Capital is 5 lakh rupees. We have calculated here. Then we take the reserves and surplus. The reserves and surplus already we have calculated 1 lakh. Here 1 lakh. Then long-term debt. The long-term debt is 3 lakh rupees. Then lastly current liability. Actually current liability consists of creditors, bills payable, bank overdraft, so many items are there. But in our problem we are not given all the values. Only current liabilities we got 2 lakh. So we assume current liability to consist of creditors. Current liabilities are creditors. So here I have taken current liability creditors 2 lakh. Now take the total on the liability 5, 6, 7, 8, 9, 10, 11. 11 lakh rupees is the total on the liability side. And here 7 lakh 50,000 plus 1 lakh plus 1 lakh 50. 7, 8, 9, 10. 10 plus 1, 11. 11 lakh. So asset side 11 lakh, liability side 11 lakh, our balance sheet is tallied. So this is the end of problem number 4. Inshallah, in the next video, I'll continue with problem number 5.